In 1759, a Presbyterian minister in Philadelphia named Francis Allison helped create the first life insurance company in America. The idea was simple and genuinely good. A man dies young, leaves a family with no income. The community pools money to protect against that outcome. Pure risk management, nothing more. 266 years later, that simple idea has been transformed into one of the most lucrative financial products ever invented. A product so profitable that the people selling it earn commissions of 70 to 110% of your first year's premium. A product so complex that most buyers have no idea what they actually purchased until they try to cancel it. A product marketed as an investment, a tax shelter, a retirement vehicle, a legacy tool, and a wealth building strategy, none of which it does particularly well compared to alternatives that cost a fraction of the price. It's called whole life insurance. And if someone has ever sat across from you at a kitchen table and explained why you need it, this video is going to be one of the more important ones you watch. My name is Larry, and I want to be precise here because this topic gets muddied fast. I am not saying all life insurance is bad. I am not saying you shouldn't have life insurance. What I'm saying is that the version being sold to most American families as a financial planning tool is, in the vast majority of cases, the wrong product at the wrong price for the wrong reasons. And the gap between what it costs and what it delivers is where enormous wealth silently disappears. Let me explain how it works by telling you about two products that look identical on the surface, but are completely different underneath. Term life insurance is exactly what the Philadelphia minister invented. You pay a premium. If you die during the term, 10, 20, 30 years, your family gets a payout. If you don't die during the term, the policy expires. No cash value. No investment component. Just pure risk coverage for the years you need it most, when your kids are young and your mortgage is large and your income is irreplaceable. A healthy 35-year-old man can get a $500,000 20-year term policy for roughly $25 to $30 a month. Whole life insurance covers you for your entire life, hence the name. It never expires. It also has a cash value component that grows over time, which the insurance company and your agent will describe as an investment or a savings vehicle. A $500,000 whole life policy for that same healthy 35-year-old costs roughly $400 to $500 a month. The difference is $370 to $470 a month. And what that difference buys you is the question at the center of everything. The insurance industry says it buys you permanent coverage, guaranteed cash value growth, tax-deferred accumulation, access to policy loans, and a legacy asset. Let's examine each of those claims against the math. The guaranteed cash value growth sounds appealing until you look at the actual numbers. Whole life policies typically grow cash value at 1 to 3.5% annually in the early years. And that's before accounting for the enormous front-loaded costs. In the first several years of a whole life policy, most of your premium goes to commissions, administrative fees, and the cost of insurance. Your actual cash value barely moves. It can take 10 to 15 years just to break even on what you've paid in. Meanwhile, that $400 difference between term and whole life, invested monthly into a low-cost S&P 500 index fund at a historical 7% return, grows to approximately $204,000 over 20 years. At 30 years, it's $453,000. At 40 years, it's over $1 million. From the difference in premiums alone. This is what financial planners call buy term and invest the difference. And the reason the insurance industry fights this advice so aggressively is because it is almost always correct. Meet two brothers, both 35, both want to protect their families and build wealth. Marcus buys a $500,000 whole life policy at $450 a month. His agent tells him it's a forced savings vehicle. It builds cash value. It's tax advantaged. It'll be there for his whole life. Marcus feels responsible. His brother Derek buys a $500,000 30-year term policy at $35 a month and invests the $415 difference into a Roth IRA and index funds every single month. Derek feels like he's doing something boring and understated. At 65, Marcus has a whole life policy with a cash value of approximately $180,000. If the policy performed at the higher end of typical illustrations, which most don't, he's paid roughly $162,000 in premiums over 30 years. At 65, Derek's term policy has expired but his kids are grown and his mortgage is paid off and he no longer needs the coverage anyway. His investment account, funded by the premium difference at 7% annual return, has approximately $491,000. He paid $12,600 in term premiums over 30 years. Derek has $311,000 more than Marcus. From the same monthly outlay, the only difference was where the money went. Now, here's where the insurance industry will push back, and I want to address it because some of the pushback contains real points. They'll say whole life provides permanent coverage. What happens if you become uninsurable after your term expires? Valid concern, but statistically rare, and the cost of insuring against that rare outcome is dramatically lower than paying for whole life from the start. You can buy a smaller permanent policy as a supplement without funding your entire insurance need through whole life. They'll say the cash value grows tax-deferred. True. But so does your 401k, your IRA, and your HSA, all of which have higher returns and lower fees. Tax deferral inside a low-return vehicle is a consolation prize, not a strategy. They'll say you can borrow against the cash value tax-free. Also true. But you're borrowing your own money and paying the insurance company interest to access it. That is not a feature. That is a fee dressed up as flexibility. They'll say it's a legacy vehicle, a way to pass wealth to your heirs tax efficiently. For ultra-high net worth individuals navigating estate taxes above the federal exemption, currently over $13 million per person, there are specific scenarios where permanent life insurance plays a legitimate estate planning role. But that is not the person being pitched whole life at a kitchen table by a commission-based agent. The commission structure is the core of why this product is sold so aggressively. A term policy might pay an agent 30 to 50% of the first year's premium. A whole life policy pays 70 to 110% of the first year's premium, sometimes more. On a $5,400 annual whole life premium, the agent earns $3,780 to $5,940 in year one alone. And then renewal commissions for years after. This is not a conspiracy. It's an incentive structure. The product that is most aggressively sold is the product that pays the most to sell. And the buyer, who has no visibility into the commission, assumes the recommendation reflects their best interest. It often doesn't. Here's the 5-step framework for making the right decision. Step 1. Separate the insurance question from the investment question completely. Ask yourself, do I need life insurance right now? If you have dependents, a mortgage, or anyone who relies on your income, yes. If you're single with no dependents and significant assets, probably not. Once you've answered that, the follow-up question is not, what kind of life insurance should I buy? It's, how much coverage do I need and for how long? Almost always the answer points to term. Step 2. Calculate how much coverage you actually need. A common rule is 10 to 12 times your annual income. A $80,000 earner should consider $800,000 to $960,000 in coverage. Run that number through a term life quote tool. There are free ones online. And see what it costs. Most people are shocked by how affordable term coverage is relative to what they've been quoted for whole life. Step 3. Price the difference between term and whatever you're being offered. If an agent is showing you a whole life or universal life product, ask them to pull up the equivalent term policy. Calculate the monthly premium difference. That difference is your investment opportunity cost. Run it through a compound interest calculator at 7% for 20 or 30 years. That number is what you are paying for the permanent features. Decide if those features are worth it at that price. Step 4. Max your tax-advantaged accounts before considering any insurance product as an investment. 401k to the match. Roth IRA to the limit, HSA if you're eligible. These accounts offer tax advantages equal to or better than whole life, with dramatically higher historical returns and zero insurance overhead. If you haven't maxed these vehicles, you have no business paying for investment-grade insurance. Step 5. If you already own a whole life policy, do not cancel it without running the numbers first. Surrendering a policy in the early years often triggers surrender charges and tax consequences. If you're past year 10 or 15, the cash value may be meaningful and worth preserving. Get a fee-only financial advisor, not the agent who sold it to you, to evaluate your specific policy before making any changes. The right move depends on your specific numbers, not a general rule. Here's the bigger picture. The life insurance industry manages approximately $4 trillion in assets in the United States. A significant portion of that is whole life and universal life premiums paid by families who were told they were building wealth, when what they were actually building was someone else's commission check and someone else's profit margin. Francis Allison's original idea, community members pooling resources to protect each other from financial catastrophe, is still a good one. Term life insurance still does exactly that, cheaply and efficiently. The product corruption happened when the industry figured out that combining insurance with investment created a product complicated enough to obscure its costs, profitable enough to fund massive sales forces, and emotionally resonant enough to sell to people at their most vulnerable. Right after a new baby, a new house, a health scare. The complexity is not accidental. A simple product with transparent costs is hard to oversell. A complex product with layered fees, illustrated returns, and professional jargon is much easier to price at a premium. You don't need complexity. You need coverage while you need it, and a simple low-cost investment vehicle doing the heavy lifting for the rest of your financial life. Those are two separate products, both of which are widely available, both of which are cheaper than the one product being sold to you as a solution to both problems. Buy term. Invest the difference. The math has never pointed anywhere else. Subscribe if this one saved you money, and drop a comment. Did someone try to sell you whole life insurance? I want to hear the pitch they used.